The goal of returning to the 2% inflation target was made more remote by the Russian invasion of Ukraine. Also, the order of globalization has disappeared. The new Cold War, divided into two camps, has begun in earnest. The Russia era, when abundant liquidity following low interest rates led to investment and consumption, and the world was able to achieve a moderate inflation rate as a single supply chain, is no longer sustainable. The political and geopolitical risks of the global supply chain reorganization that began with the technology competition between the US and China and the Russian invasion of Ukraine ended the Goldilocks period of low interest rates and low prices. It is not easy to achieve 2% inflation in a situation where cheap goods, low-wage workers, and large-scale capital have all fled. The reason the United States has been able to live in an era of low interest rates and low inflation has been with the help of China and Mexico. The Goldilocks era was possible for a long time because China's cheap goods and Mexico's cheap labor were supported. Goldilocks is a compound word of gold meaning golden color and locks meaning hair. When this word is used in economic terms, it is called the Goldilocks economy. It refers to an ideal economic situation where prices do not rise despite high growth. In the last 10 to 20 years, prices have risen moderately. If there is too much liquidity in the market, there is a risk that prices will soar. However, the rise in prices was able to be controlled thanks to the free movement of goods, labor, and services. At the time, the efficiency of production factors such as capital, labor, and raw materials was maximized, and the market for consuming them was also opened, maximizing economic utility. This period was an ideal economic situation. But going back to the past is virtually impossible due to the Xi Jinping's government's birth control and zero corona control policies. It is not easy to reproduce China's mass production system as in the past. Due to the US-China conflict, even one axis of the global division of labor system, which China was in charge of, has collapsed, and cheap labor from Latin American countries, including Mexico, is not being supplied. This is because of the anti-immigration policy that has been strengthened since the Donald Trump administration. Even after entering the Joe Biden administration, this direction has not changed significantly. Chairman Powell continues to raise the inflation target of 2% year on year, which he has emphasized throughout this year. He insists on 2%, not 1% or 3%. The 2% believer is not only Powell, but also current Federal Open Market Committee members, as well as their predecessors. former Fed Chairman Bernanke, who first introduced the 2% inflation target, said at a press conference commemorating the Nobel Prize in Economics in October 2022, changing the 2% inflation target is not good for the credibility of the Fed. The Fed insistence on the 2% figure is because it was once a realistic target. Just last year, prior to the pandemic, inflation in the United States was below 2%. Around 1995, the Fed thought 2% was the right level for inflation, said James Blood, president of the Federal Reserve Bank of St. Louis. In the 1970s, inflation was very high, but it was a big problem because inflation expectations were jagged. However, it was only after 1995 that it finally started to come down. At that time, the inflation level was 2%, so people started to think that 2% inflation was reasonable. The moment you abandon the 2% target to catch inflation, you judge that you have more to lose. This is because it can lose confidence in central bank monetary policy and give the wrong signal that the Fed is tolerant of inflation. On Wall Street in New York, the world's financial center, there are calls for raising the inflation standard. This is why sticking to the outdated goals set 10 years ago could actually damage the economy. On the other hand, there are strong counter-arguments that a sudden change in the long-held target may undermine trust in the central bank and increase uncertainty. The first official target of 2% appeared through the FOMC statement on long-term goals and policy strategy announced in January 2012 when Fed Chairman Bernanke was in office. At the time, Chairman Bernanke explained that the 2% target could promote price stability and maximum employment. The reason why the rate was not set lower than 2% was because it needed defense against deflation. If the inflation target is set at 0%, there is no room for interest rates to be lowered even if deflation hits. 2% serves as a minimal buffer to ensure that interest rates do not go negative during a recession. When looking at inflation, the Fed places most importance on trend in personal consumption expenditures, especially the core PCE, excluding volatile food and energy, rather than the popular consumer price index. Unlike CPI, which has a wider range of items than CPI and adjusts the proportion of items every 2 years. PCE updates quarterly to promptly reflect consumption patterns. Core PCE stayed around 2% from 2012 to 2020, faithfully meeting the Fed's expectations. However, it has risen to the 3% level since 2021, when the Corona-19 pandemic began in earnest. In January of this year, it soared to 5.2%, the highest level in 40 years. Core PCE for November, released on December 23rd. It forecasted to rise 4.7% year-over-year, although it has slowed down slightly from October. It is still infinitely higher than the 2% target. As a result, some on Wall Street are criticizing the Fed for continuing high-intensity monetary tightening while shrinking the economy to meet each gold target. Wall Street's leading real estate investor Barry Sternlich, CEO of Starwood Capital, recently told Fortune 2% is just a kind of random number that you can go. There is no demand and goods can enter a world of too much deflation. Not only the United States, but also the central banks of major countries, including the Bank of Korea, are commonly setting a 2% target, with the exception of some emerging economies, such as South America. Most central banks are designing monetary policies with a target of 2%. It is realistically difficult for the Fed to raise its target alone. Allies of the United States, such as Germany, Japan, and South Korea, suffered large-scale deficits, while the United States posted large-scale surpluses. Until recently, the profits of these countries flowed back into the U.S. asset market and served as a source of funding for the stock and bond markets. But now these countries are also mired in inflation and suffering from trade deficit. Rather, these are opinions that a more realistic alternative could be to raise the growth rate amid inflation of 3 to 5% while maintaining the base rate at 3 to 4%.